Still on our series of solving past questions from WAEC, where we don't only show the correct answer, but I show you why they are correct, and I also show you why the other options are wrong. Welcome to MWS tutorial where accounting, economics, and finance are made simple. Let's continue from where we stop. Here is question 11. Use the following information to answer question 11 to 12. We are giving the question of this. Given prime cost $36,700. The currency is given as dollars is not naira or dollar. Dollars is a Gambian currency. So factory overhead $6,600. Work in progress 1st January 2024 $4,300. Work in progress 31st December 2024 $2,600. That is to say, this is opening stock work in progress, and this is closing stock work in progress. Then cost of goods sold at $8,000. Here is the question. The cost of goods manufactured is A. $51,200. B. $44,000. C. $43,300. D. $42,600. Let's determine the correct answer. So we are to determine the cost of goods manufactured. So let's say cost of goods manufactured is equal to prime cost has to be included, it's part of it. Prime cost. This is the direct cost. Factory overhead plus factory overhead. Factory overhead plus opening stock work in progress. Work in progress. Opening work in progress. Less minus closing work in progress minus closing work in progress. This should be our formula. If you want to determine the cost of goods manufactured, you are going to have the summation of your prime cost, that is your combination of direct cost, plus factory overhead, your indirect cost, plus opening work in progress minus closing work in progress. Remember, opening work in progress is the opening stock for the last year. Opening stock for this year you borrowed from the last year. So there are still incomplete. You complete in the previous year. You completed it this year. And the reason why we are deducting closing stock, there are some works, incomplete works, that has to be deducted for this year. That's why we have to deduct it. So let's put the figures and see our answer. Prime cost is given as 36,700. Cost of goods manufactured is equal to prime cost 36,700 plus factory overhead is given as 6,600 plus opening stock Opening work in progress 4,300, 4,300 minus closing work in progress less closing work in progress. Closing work in progress. That is how much? 3,600. 3,600. So let's have the summation. 36,000, 36,700 plus 6,600 plus 4,300 dollars is minus 3,600. So the summation here will be 44,000 dollars. This should be our answer. Let's check the right answer. Yes, our answer is B. Our answer is B. That is $44,000. Then the next question asks on the stock of finished goods on 31st December 2024. This is telling you about the closing stock. Closing stock. So closing stock, let's say closing stock is cost of goods manufactured. We are going to say cost of goods manufactured. Cost of goods manufactured minus cost of goods sold. Cost of goods sold. Let's say, for instance, you produce goods worth 10,000 naira, for instance. You've sold goods of 8,000. You've sold the goods worth 8,000 naira. So if you want to determine your closing stock, the unsold goods, you are going to say the cost of goods you manufactured minus the cost of goods sold. So that's how we are going to determine it. Then you can say 10,000 minus 8,000. That should be equivalent to 2,000. So this is how we are going to calculate this. So now, remember, we have already determined our cost of goods manufactured. That is $44,000 is here. $44,000 is minus cost of goods sold. See, cost of goods sold, $38,000 is $38,000. So our answer should be 44,000 minus 38,000. Our answer should be 6,000. Our answer should be 6,000. So let's find our answer, the one that fits our answer. The answer is C here, according to the solution. The answer is C. Okay, question 13. An item on credit side of total creditors control account is A. Cash refund from supplier. B. Return outward. C. Bill payable. D. Cash paid to supplier. So remember, credit side of total creditors control account. Remember, creditors control account is an account of those we owe them money, our suppliers. So whatever is on the credit side, it shows the amount we owe them. Whatever is on the debit side, it reduces the amount we owe our creditors, we owe our suppliers. So therefore, let's look at this. Cash paid to supplier. When we pay cash to supplier, this reduces the burden of our debt from the supplier. So therefore, this one should be deleted, because we say whatever is going to reduce the debt, the burden, should go to debit side. Whatever is going to increase the burden should go to credit side. In case you want to learn more about creditors control account or control account in general, scroll through the playlist. You are going to see the question on control account. I will solve the question. So this one should go to debit side, and this is not the answer. Why? Because the question is talking about the credit side of total creditors control account. Then let's say bill payable. Bill payable. Bill payable also transfer the amount from ordinary creditors to bill payable. Therefore, it reduces the burden of the debt. So therefore, this is not the answer. We are talking about what will be on the credit side. This one should also be debited on the creditors control account. Then return outwards. You made a purchase. You decide to return some part of the goods due to some default. So, definitely this will reduce the burden of debt you owe your creditors. So because of this should also come to debit side, because we say whatever is going to reduce the burden of the burden you owe your creditors should go to debit side or creditors control account. Therefore, this is not the answer. But cash refund from supplier, maybe when you make an overpayment, a supplier decides to return some cash to you, to refund something to you. This will definitely appear on the credit side of supplier or creditors control account. Cash refund from supplier will appear on the credit side of creditors control account. So therefore, A is the answer. A is the answer. Now, carriage on sales, question 14. Carriage on sales is charged to A, appropriation account, B, trading account, C, profit and loss account, D, balance sheet. This carriage on sales. Carriage on sales is like carriage outward. So carriage outward. When a customer purchases the goods of taking the goods, the money for taking the goods to the customer is what we refer to as carriage outward. So now, sales is charged to, where do we charge it? This is the question. We charge carriage outward on the profit and loss, in the profit and loss account. But don't confuse yourself between carriage outwards and carriage inwards. This is the money for bringing the goods, you paid for bringing the goods to your shop. It is charged on the trading, in the trading account. It's added to the purchase. It is added to the purchase. But these are goods of taking the money for taking the goods to the customer. Therefore, this one is charged in the profit or loss account. This is selling expenses. It's charged on the this is selling and distribution expenses. It is charged in the profit or loss account, while this carried inward is charged in the trading account. So, question 15 says sales less return inward equals A, gross profit, B, gross sales, C, net profit, D, net sales. Your sales less return inward, your sales less return inward is equal to net sales. Let's say your sales is 100,000, 100,000 for instance. But customers decide to return some goods worth, let's say, 10,000. So you're going to minus 10,000. If you are asked to determine your net sales, you are going to say 100,000 minus 10,000. So therefore your net sales should be 90,000. So this is the answer. Sales less return inward is net sales. This is very straightforward questions. Then question 16 says the preparation of statement of affairs from incomplete record is determined by A. Cost of goods sold, B. Capital, C. Sales, D. Purchases. Look at the question. The preparation of statement of affairs from incomplete record is determined by capital. You know, in the preparation of in incomplete record, if you might not be given a capital, you want to determine the capital. So if you want to determine the capital, sorry. Okay, the keyword here is statement of affairs. Statement of affairs. You prepare statement of affairs in order to determine the net worth of the business. Net worth of the business. Net worth. Or you can call it capital. Capital of the business. That's why you prepare statement of affairs in incomplete record. It's to determine your net worth or to determine, or you can call it capital. So how do you determine your capital in incomplete record? It's just for you to say capital. Capital is equivalent to assets minus liabilities. Assets minus liabilities. Let's say you have assets of 5 million, liabilities of 2 million. Your net capital, your capital should be 3 million. Just as simple as that. So the answer to this is B, capital. Okay, question 17. The concept which underlies the provision for doubtful debts is A. Objectivity concept, B. Prudence concept, C. Going concern concept, D. Entity concept. So what is doubtful debt? Before preparation of accounts, there could be some customers you might have a doubt if they will be able to pay their debt. Let's say customers owe you 100,000. 100,000. But from this 100,000, you doubt if 10,000 will come from a customer. So are you going to prepare your statement including that 10,000 that you still doubt about it? The answer is no. You are not going to include that 10,000. So that you are not going to overstate your profit or overstate your assets. So in order not to do that, therefore, we are going to report 90,000 as your debtors. Because the 10,000 is under probability. It might come, it might not come. So therefore, this is prudence concept. Do not overstate your assets or your profits. So the concept that emphasizes that is prudence concept. That is B also. Number 18. The capital of our social club is referred to as A. Consolidated fund, B. Accumulated fund, C. CD. Surplus, D. Deficit. Social club. In business, the money you operate the business, the money you start the business, call it capital. But in non-profit organization, we call it accumulated fund. Our answer is B, should be B. Accumulated fund. In every non-profit organization, it is called accumulated fund. It is determined by total assets minus total liability. The difference should be your accumulated fund. Then question 19. Double entry posting implies that a transaction is recorded A. In the journal and in the ledger. B. In the two ledger accounts. C. Twice in a particular ledger account. D. At twice it is valid. We are taking the question is asking us about rule of double entry, the rules that says for every debit entry there must be a corresponding credit entry. So in the journal and in the ledger, this is not the answer actually. In the journal and in the ledger. In the two ledgers account, yes, this is the answer. Let's in the two ledgers account, every transaction has to affect two ledgers. Let's say for instance, you purchase a chair worth 10,000, or let's say furniture, purchase furniture worth 10,000. 10,000. This transaction has to affect two accounts. Number one is going to affect furniture account. Number two has to affect, let's say the transaction is on cash basis, has to affect cash account. Cash account. What will happen? You are going to delete furniture account and you are going to credit cash account because cash paid the money. If you find the video helpful, like the video, share it, and drop a comment and tell me the next question you want me to solve. Thank you.